AI is forcing me to change how I manage my money. You see, I've made millions from investing over the past 35 years, and most of that success has come from one simple strategy: an S&P 500 low-cost index fund. The S&P 500 has returned an average of over 10% per year. This is known as passive investing, as your money automatically gets split between the top 500 companies in the USA. Rather than having to actively pick winning stocks, you instead just buy a small piece of all of them. The idea is that even if some stocks crash, owning lots of them protects you, and you still benefit as the overall market grows. I'm not going to lie, over the years this has been proven to be a fantastic strategy. However, after reviewing my investments recently, I've made a few changes. Believe it or not, for every dollar you invest into the S&P 500, 40 cents of it goes into just 10 companies. These are Nvidia, Microsoft, Apple, Alphabet, Amazon, Broadcom, Meta, Tesla, Berkshire Hathaway, and JP Morgan. What's even more concerning is that Nvidia alone takes up nearly 8 cents of every dollar you invest. These companies aren't being valued based on what they earn today, but on what investors expect them to earn in the future. I want you to imagine for a moment that the biggest stock market returns over the next 20 years don't come from the USA. I know that sounds crazy because for the last 14 years, American markets have dominated. But if you look at the global stock market like a cake with multiple layers, you'll see the thickness of those layers always changes. In 1900, the United Kingdom was the global superpower with a 24% share of the global cake. In the late 80s, it was Japan. Leadership changes, economic dominance shifts, and no country stays on top forever. That is why I don't want my portfolio to rely entirely on one market. I break the market down into 4 clear zones. First, the crowded zone. These are the high valuation giants like Nvidia and Tesla. Second, the defensive zone. Stable businesses like McDonald's and Coca-Cola. Third, the speculative zone. Smaller, hyped companies that I generally stay away from. And finally, the overlooked zone. This is where the real opportunity is. These are small and mid-cap businesses that don't need to win the AI arms race. They just need to apply AI to real problems at a lower cost. That is where I'm backing the underdogs. Is changing power, currencies, and trust in the system. That's why I'm increasing my gold reserves. As of 2025, gold has been reclassified as a Basel III Tier 1 asset, meaning banks can treat it the same as cash. I'm also holding more cash, just like Warren Buffett, who currently has a record $347 billion cash pile. My strategy is simple. I'm staying in the market, but I'm diversifying into global stocks, gold, and cash to prepare for whatever comes next. If you want to grow your wealth, don't just follow the crowd. Be prepared. Building wealth is half the battle. Protecting it is the other. I've linked my trusted partner for securing physical gold in the description below. It's the same strategy the central banks are using right now. Once you've secured your foundation, click the video on the screen to learn how to avoid the biggest tax traps for Canadians in 2026. I'll see you there.